This is InvestTalk. Independent thinking, shared success.
Hey guys, I imagine this is a pretty popular point for today, yesterday, and today, but I was just curious about NVIDIA. Obviously, they took a hit. We're down at 117, and now it's back to 127. Would you still recommend getting in? Thanks. Bye.
So I don't think I have to tell anybody at home what NVIDIA, ticker NVDA, does, but I still will. They are a leading technology company, and they manufacture GPUs, which are graphics processing units. Way back in the day, they were probably more known for those GPUs being used in gaming computers, gaming consoles, gaming. But over time, these GPUs were developed such that they are essential inputs and what AI models, large language models, are run on. And so, as you could expect, given that this has been the secular driving theme for over a year now, given the explosion in CapEx from not just tech companies, not just the companies within the supply chain for these large language model inputs, but broadly to incorporate quote unquote AI into their businesses, companies have spent billions of dollars, billions with a B. And so on Monday, when there's discussion about a paper, about a product, a startup out of China called DeepSeek that managed to do what OpenAI did with ChatGPT, but more efficiently and cheaper, everyone thought, oh no, the entire value proposition of NVIDIA is exactly what I have been saying this entire time, predicated upon all of these assumptions being correct, that large models are going to be better and more efficient than those smaller counterparts, that people don't incorporate an internal foundry system into their businesses, and it really hit at the first one. Is this going to hurt demand? Now, personally, I think all this proves is that there is more efficiency and therefore you can use them more cost effectively, which would really boost demand. But the real ramifications, the real side effects down the road are yet to be seen. And so NVIDIA, who was down 17% yesterday, was up 8.9% today. There is still a lot to find out as people dive into the paper, the open source code, and figure out, okay, what does this mean for the bottom line of these companies? With that being said, right, this company has outperformed in 2023 and 2024, up 238% in the first year, 2023, and up 171% in 2024. Even with this little drawdown, it's still trading at 26 times forward-looking earnings, certainly below its average of 40 times, still trading at 44 times its book value, 25.9 times its sales. I think this could be a little bit of a crack in the armor in terms of the necessity to have these broadly expensive, massive products. And certainly the market's still digesting it. This is extreme volatility. Down 17 one day, up 8 the next day. So for now, I'd stay out of it. It could easily move against you. I think it's a little overblown, the reaction. But still, the market is still digesting this news. NVIDIA, as always, is still incredibly expensive. But maybe, who knows, maybe less of a critical piece in the future of AI than many had thought. Thanks for the call. Let's go to Mark in New York, who has a question about LVMUY. Do you own it or are you looking to buy it?
Looking to buy it. I've been eyeing it for a while, and I'm just wondering if right now is a good price point to get in. Thanks.
Of course. Thanks for calling. Let's take a look at LVMUY. That is a mouthful of a ticker, but it is even more of a mouthful of a name. It is Louis Vuitton Moet Hennessy. It is an ADR of a European company that has some of the most recognizable brands in fashion. Louis Vuitton, Christian Dior, Givenchy, all sorts of brands. And so they recently reported earnings, and it didn't go too well for them. They're down about 2.2% today on the back of that earnings announcement. And so on the top line, it looked okay, right? They beat expectations, but profits dropped 17% year over year, largely because of exchange rate fluctuations. And more than that, I think there are some issues on the horizon for LVMH. You know, every time we bring a focus point to you guys, Justin and I have a lot of discussion about what we think is important to know. Some of these scam ones, like the one we have today, are very important to know. But what can influence the broader economy and stocks in general? And one of the stories, I'll tease it for you, that we're talking about next week is how typically we've seen over the past year issues with the lower income earners and their spending abilities, but we're starting to see cracks in the upper earners as well. And so certainly if earnings guidance wasn't that great, which it was not that great, if the profits fell as much as they did, this is important context for what might happen with some of these luxury retail brands. Now, this company specifically is pretty expensive, about 26 times forward-looking earnings, about 4.3 times price to sales. But that's because the revenue has grown pretty significantly over the past 5 years, though they did hit a peak in 2023. You do see in 2024, right? You see a drop-off from 93 billion to 88 billion. Right now, they have their projections of going back up to 92. Is that going to happen? I don't know. If you have a weakness in their exact customer base, a lot of which comes from the United States, that doesn't stand too well for this company. And it's a massive company. As I said, some of the most well-known brands. So for me, I love this company as a business. I think it would be my dream job to be CEO of this company. It would be a fun one. And they've certainly grown, and their acquisition strategy has been great. And Bernard Arnault is a great CEO. But in spite of all this, I think there is an issue here, which is the overlying macro trend of upper earners scaling back. And so for now, I would wait to see how this plays out. I think over the next couple months, some of the macro data on retail spending, some of the Q1 GDP is going to tell us a lot. Obviously, that's a little bit away about what to expect for companies that are predicated upon a lot of disposable income. So LVMH is on my watch list, and I think it should stay on yours. I don't think right now is a good time to buy. Thanks for the call. Now, I hope you've been telling all your friends and family members that our InvestTalk audio podcast is also available in video form over on our YouTube channel. It seems like every day now we receive finance and investment questions in the comments section of our YouTube channel. That's great because we love question diversity, voicemails, live calls, comment section, iTunes reviews. If you want to send us a letter in the mail with a question, we'll do that too. It'll take longer to answer, but we'll still answer it. And this one comes in, and it's about ticker IFP. It says, in consideration to recent discussion of higher tariffs on Canada, will you recommend Interfor Corporation, ticker IFP, as a lumber wood play? If not this company or industry, then which industry would you think would benefit from the situation of potential spikes in tariffs? So let's take a look at Interfor Corporation, that is ticker IFP. And so if you're talking about, first and foremost, what company is going to benefit from tariffs, if you're a U.S. investor and the demand is in the United States, you would not want a Canadian company. A tariff is a tax on the importation of goods from another country that is generally nearly one-to-one passed on to consumers, right? We saw this in 2017 on the original tariffs that Donald Trump put in place. And so, yes, it raises money that consumers pay through this tax, but it effectively makes imports more expensive. And so it would actually generally hurt foreign businesses in favor of cheaper domestic businesses. And so to keep this question short, because I think the answer is short, if you think that there are going to be higher tariffs on Canada, you're not going to want to invest in a Canadian lumber company.
Hi, Justin and Luke. This is James from New York. I have a general question. 20-year Treasuries hit about 5% recently, and I'm wondering, if you're in your early 30s, would you allocate some of your portfolio, say 5 to 10%, to long-term Treasuries, or should I just continue to put into indexes and into equities? Just wondering, is it worthwhile if you still have 30 years, 40 years to invest, if it's worth it to buy these long-term Treasuries at 5%? Thank you.
So this is a good question. You know, the old rule is 120 minus your age is what you want in equities. Now, that is just a rule of thumb. It's not something that you need to have set in stone. It also only considers you having a fixed income and equity allocation. But what that means is, if you think about it, is the general principle tells you when you're younger, because your time horizon is longer, because you're not going to need the money anytime soon, hopefully, you can take on the additional risk to build capital, right? The primary purpose of having a high equity allocation is to build your capital. And so by having your equity allocation be 120 minus your age, that means that as you get older, you have less and less in equities and more in fixed income. Because as you get older, you're more concerned about using that capital, preserving that capital. Now, your question is about a 10% allocation to, let's just say, long-term treasuries. Now, this rule tells you, well, 120 minus 30, 90% in equities, and therefore 10% in fixed income is perfectly reasonable. But I will say, you're going a little long on duration, right? Long-term treasuries tend to underperform inflation over longer periods of time. And if you think we're moving into a higher inflationary environment and you think yields are going to be pressing upwards, well, then you're locking into potentially lower yields, at least from a historical perspective, for a longer period of time. You could see some losses there. We're also in an environment where you can get some pretty good yields on corporate bonds with relatively low risk. And so I would say it's perfectly reasonable if you want to have an allocation of 10% to fixed income. I think that's fine. I don't think it's necessary, but I think that's fine. But what I wouldn't do is take that and reach to the far end of the yield curve and lock it into something that exposes you to a lot of duration risk and puts you at a disadvantage in an inflationary environment. Thanks for the call. Let's switch back to our YouTube question bank and answer this question about ticker AIRR. AIRR is an ETF, by the way, but this question says, hi, Justin and Luke. I'm invested in an ETF, AIRR, and I'm up 22%. It's currently 10% of my portfolio, and I'm wondering, should I trim it back? Would like to hear your thoughts on this ETF and whether I should hold, cut, or even add more to this position. The ticker AIRR is First Trust RBA American Industrial Renaissance ETF. That is a mouthful. It is a passively managed fund that selects large and mid-cap U.S. companies from the Russell 2500 with the following industries: commercial services and supplies, construction and engineering, electrical equipment, and banks. Firms have to have positive 12 months forward earnings consensus estimates to be considered in the index. It excludes community banks outside traditional Midwestern manufacturing hubs, as well as non-U.S. sales of more than 25 firms with non-U.S. sales of more than 25%. Focuses on profitability as well. And so taking a look at its portfolio statistics, right, these weighted average characteristics, which you can tell a lot about a portfolio from looking at. I see a fund that has a little bit of concentration, has a lower dividend yield than its segment benchmark, has a lower price to book, meaning there's a little bit of an emphasis on value there. Price to cash flow is a little bit lower as well, so definitely a value-oriented. Price to sales, a little bit lower, value-oriented. Price to earnings, 23 times. So definitely a value-oriented approach relative to its benchmark, which again is the Russell 2500, is what it's trying to track, though its benchmark is the MSCI USA IMI. So the first red flag here is its prospectus benchmark is not at all what it's trying to invest against. So it's not really a good benchmark for this fund. Now it is tilting towards the mid-cap space, which you'd expect again with the Russell 2500. 77% in mid-caps, 16.59% in small caps, all industrial names. And most of its revenue, because of that rule, about its revenue being in the US, is from the US, about 92% of it. It's got 53 holdings. Looks pretty well diversified because you know what? The top 10 names all have about 3% allocation. So what I'm seeing here is a value-oriented, profitability-focused industrial ETF that charges 70 basis points. That's about 1.1% in tracking error, so it does a pretty good job of tracking what it's trying to track. But frankly, over the past year, it's up 42%. Over the past 3 years, it's up 26%. I think that 10% allocation to industrials, especially a high-cost industrial ETF that is pretty focused on mid and small caps, is probably a little bit more than you want. I would not be investing more here. I would be looking to take some profits, start to trim down, probably bring it back down to the 5 to 7% range. Thanks for watching. Let's go to another live call. Roger, who's listening in the Bay Area on AM 1220. You have a question about ITRN. You own it or are you looking to buy it?
No, I was just looking at the ticker, and I impressed by the chart the past year or so. The numbers look good. Just wanted to take your opinion on it.
So you've been tracking it for just about a year or two, you said, or you looked at a chart over the past 2 years?
Yeah, I was looking at the charts over the past 6 months to 1 year, and they seem to be good, but just wanted to see what's your take on it.
Okie doke. Let's take a look at ticker ITRN. It engages in the provision of stolen vehicle recovery, fleet management, and tracking services. So they essentially provide products that help to recover and track vehicles, commercial vehicles, generally maybe a little bit of retail consumer vehicles as well. Now, over the past year, the performance has been pretty solid, up 22% in the past 3 months, up 30% over the past year. From a growth perspective, it looks okay as well, right? Up 4.8% on an annualized basis going back to 2019, but net income has fallen. Net income has fallen from that's an interesting figure right there. Net income has not fallen. I don't know why that 5-year annualized growth rate is negative, but regardless, net income has grown from 48 million to 53 million this most recent year. And in terms of their margins, looks pretty good, right? Especially for a component manufacturer. Their net margin has grown from 2.5% in 2019 all the way to 15% last year, projected to be almost 16% this year. What about their cash flow? Well, the cash flow is improving as well. It's been improving since 2020. They've been buying back shares a little bit. They have a very high dividend yield, unexpectedly high, I would say 4.7%, nearly double what it has been over the past 3 years. So that may be a little bit of a worrying sign, but you know what? The stock is up, so there hasn't been selling pressure that's been putting that down. So I'm going to chalk that up to share buybacks generally, going from about 24 million to 20 million shares outstanding. Now, it's a $695 million company, got very little debt. In fact, it has single-digit debt, $5 million, well, I guess single-digit if you look at it in millions, $5 million in debt. So this company does not capitalize itself with equity. It does not capitalize itself with debt. It uses its revenue, reinvests its profits, and helps to grow its business. From a forward-looking earnings perspective, it's trading at about its averages. Price to sales is about 2 times. Price to cash flow about 9.1 times. 11 times forward-looking earnings. And the chart has been consolidating, I would say from February until about November. Then it started to be in an uptrend, hit a high of 34, and now it's consolidating again. You know, overall, what I'm seeing here is a company that has pretty solid growth, pretty solid financial performance as well. It surpassed its analyst expectations in the last quarter by about 5 cents, so just under 10%. And so, you know, I think this is actually a pretty solid name. I like names that don't have a lot of debt, but also don't capitalize themselves by diluting current shareholders. They're using those profits, which are growing. They're using that revenue, which is growing, to reinvest in the business. And it looks pretty fairly priced to me. I wouldn't think about diving head first into this thing, but I would start to pick up a small allocation here. It's been really underperforming the S&P 500 from a relative strength perspective, but it's trying to get back to where it was, back in 2019, where it was about dead even there. So I would start to make a small allocation if I was looking to invest in this name. I'd probably call it a moderate buy. I mean, the growth isn't too exciting. It's good that their margins are expanding, but if you're looking to get some exposure in this space, I think this is a perfectly fine way to do it. Thanks for the call, Roger. Have a wonderful day. Now let's talk a little bit about a bold new shift in that President Donald Trump is embracing cryptocurrency like never before. Just 3 days before his inauguration, he encouraged supporters to invest in Trump coin. And now an executive order issued on January 23rd makes it clear that crypto is here to stay. This order that digital assets will play a crucial role in innovation, economic development, and U.S. leadership on the global stage doesn't necessarily have as much force and effect, but is more symbolic of what may be to come. And more than anything, it's a stunning reversal from the previous administration. Under President Biden, financial regulators worked to limit crypto's influence on Wall Street, making it pretty expensive for banks to hold digital assets and block their ability to launch stablecoins, which are cryptocurrencies pegged to the dollar. But under Trump, crypto's no longer fighting against the system. It's becoming part of the system. The impact is already being felt. On January 23rd, the SEC removed restrictions that forced banks to account for crypto assets on their balance sheets, and this is a game changer. These moves paved the way for traditional banks to really dive into crypto, launching trading desks, stable coins, and even digital asset custody services. Brian Moynihan, CEO of Bank of America, has already said that banks will embrace crypto-backed transactions. Some major institutions are even looking at acquiring crypto firms, while crypto companies may soon start buying up banks to gain access to the Federal Reserve's payment system. But not everyone's happy. Federal Reserve has long resisted giving crypto firms direct access to its master accounts, which allow payments to be processed without intermediaries. Traditional banks want to keep it that way and have lobbied aggressively to keep the system closed. The Bank Policy Institute and American Bankers Association argue that crypto firms pose a risk to money laundering, terrorist financing, and cybersecurity threats. The fight over access to this payment system is set to intensify as Trump appoints new officials to the Federal Reserve. While he may push for more crypto-friendly candidates, the Fed's 7 board members serve staggered 14-year terms, meaning change, if any, will be slow. But there's also a dark side to the crypto revolution. Despite its rapid growth, crypto remains incredibly volatile and pretty dangerous. In the past 2 years, some of the biggest players in the industry collapsed, due not just to mismanagement, but also to fraud. Michael Barr, the outgoing head of financial supervision at the Fed, has warned that cryptofication could destabilize the financial economy and the financial system itself. If crypto prices crash again and banks are heavily exposed, the risk of bank runs and economic turmoil increases. It's what we call contagion. Think back to 2008, 2009, with mortgage-backed securities. Banks were using them as collateral for additional loans. When they became worthless, a bunch of banks had to put up a bunch of collateral at the same time as asset prices are falling. You have a system in crisis. Now, with Wall Street and blockchain merging, the stakes have never been higher. For banks, the opportunities are massive. But for consumers, the risks are real. As the US dives headfirst into the crypto-powered future, only time will tell if this gamble pays off or if it leads to financial chaos. And so, as always, be vigilant. Realize that it's not always wise to dive into the new flashy thing. Let's keep things moving and swing back to the InvestTalk voice bank.
Hey guys, great show. It's Mike from Orange County. And my question today is about Berkshire Hathaway Class B. The market has about 15 minutes left and it's up almost 2% for the day. And it looks like the rest of the market is down substantially. S&P's down to 1.5 and NASDAQ's down almost 3. Trying to find some news, wondering why Berkshire is up today. Have a good day. Thank you. Bye.
So I imagine that this question came in on Monday when the rest of the market was down rather. And so Berkshire Hathaway, for those of you who do not know, is the company that is and has been run by Warren Buffett and Charlie Munger for a while. And it has been doing particularly well recently. It has been doing so well, and we've actually had some clients ask about Berkshire Hathaway and should I invest more money in Berkshire Hathaway. It's up about 3.6% year to date, up 21% over the past 52 weeks. But there are many reasons why this company is a good investment, broadly speaking. But is it a right investment now? There's a lot to dive into, and we actually have to head into another break. So when we come back, we'll talk more about Berkshire Hathaway and if now's a good time. Before the break, we were talking about Berkshire Hathaway, and on Monday, it was up while the rest of the market was down. But that is, I think, a fundamental misunderstanding of what these indices say. Yes, the top line, the S&P 500 was down, but 300 companies were up. And so you can't just look at these indices that have become trackers that are heavily influenced by a handful of names, all of which have floated valuations because of one secular growth theme, and think just because they are down, well, this company that is up might be great. Now, it is true Berkshire Hathaway is great. One of the reasons why it was probably up is because its largest holding is Apple. It has a lot of exposure to Apple, American Express, Bank of America, Coca-Cola. And so with Apple doing well on Monday, well, Berkshire was doing well as well. But if I want my key on Berkshire Hathaway and when to buy Berkshire Hathaway, you don't really need to look further than Warren himself. Berkshire's trading at 23 times forward-looking earnings, 25 times cash flow, 2.8 times sales. It's the upper end of its 5-year range. They stopped buying back shares. That tells you that Warren Buffett thinks that it's too expensive. So if you want your indication of when it is a good time to buy Berkshire Hathaway, listen to the Oracle himself. When he starts buying, so do I. Thanks for the call. Now, investor enthusiasm for artificial intelligence has reached new heights. But Ray Dalio of Bridgewater warns that the AI boom resembles the dot-com bubble of the late 90s. In an interview with the Financial Times, Dalio said that stock valuations have climbed to unsustainable levels, and combined with risks posed by higher interest rates, the market could be headed for a painful correction. Dalio compares today's market to 98 and 99, when excitement over the internet led to massive stock gains before a brutal crash. Back then, the NASDAQ 100 doubled in 1999, only to plunge by 80% in the years that followed. Now, the NASDAQ has doubled since the beginning of 2023, led by AI stocks like NVIDIA, fueling concerns that history may be about to repeat itself. These concerns deepened on Monday, when Chinese AI company DeepSeek claimed its new model rivals those of OpenAI and Meta, but at a lower cost and without relying on US semiconductor technology. That news sent shockwaves through Wall Street, wiping nearly $600 billion off NVIDIA's market value in a single day, though it has since recovered a little bit. Silicon Valley has invested hundreds of billions into AI infrastructure, expecting US firms to dominate. But if China can develop cutting-edge AI without American chips, the entire thesis can be at risk. Even leading AI companies are struggling to turn a profit. OpenAI recently announced a $500 billion investment in infrastructure, but CEO Sam Altman admitted that the company is losing money on its $200 per month ChatGPT Pro plan. If even the biggest names in AI are struggling to generate sustainable revenue, are investors underestimating the risks here? Beyond the markets, AI has become a geopolitical battleground. Dalio warns that the competition between China and the US is about more than just business. It's a fight for economic and military dominance. And so, understandably, governments are stepping in with aggressive funding strategies. China's launched major financial assistance programs to support its AI and semiconductor industries, while the US under Joe Biden extended billions in subsidies to domestic chip production. And Donald Trump has pledged even greater support for American AI development in his second term, intensifying the global AI arms race. Dalio believes this shift marks the beginning of a new era where governments play a much larger role in AI development. He argues that capitalism alone cannot win this battle. As AI is now tied to national security and global infrastructures, governments will need to shape AI's future, deciding which companies and technologies receive support. And so with AI valuations soaring, competition between China and the US escalating, and profitability still the biggest of question marks, now could be a critical moment for markets. If Dalio's right, the AI bubble could boost sooner than expected, bringing serious consequences for markets and global dominance. But this goes back to what I just said to that last question, which is, just because an index is underperforming doesn't mean all stocks within it are. 2025 could be the year of breadth, the year of diversification. I'm Luke Guerrero, and this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads. Get yours anytime at iTunes, Google Play, and Spotify. Please be sure to leave us a rate and review on iTunes. Remember, we can help you better understand your portfolio dynamics, calculate your investor risk number. Just go over to investtalk.com, click the portfolio review button. This is a free and confidential service. We also help countless clients optimize the potential of their 401ks and build personal financial plans and full wealth outlooks to help you in your daily life. It all starts at InvestTalk.com. Independent thinking, shared success. This is InvestTalk. Good night.